Welcome back to another lecture of the Ethan Trades Mentorship. In this lecture, I wanted to give a brief overview of what the financial markets actually are. In this way, you have a general idea of what it is that you're getting yourself involved in. And with this in mind, if trading is a business, you'd want to get to know the product you're trading, right? So this stuff is boring, but I promise if you get through the boring stuff, it will tremendously help you in your journey. So let's get into it. The financial markets refer to the various platforms, systems, or networks where individuals, institutions, and entities engage in the buying and selling of a financial asset. These assets can include stocks, bonds, currencies, commodities, derivatives, and other instruments. The financial market serves as a mechanism for the allocation of capital, price discovery, risk management, and facilitating the transfer of funds between savers and borrowers. In essence, financial markets provide a marketplace where participants can trade financial instruments, determine their values, and access capital. The transactions in these markets are driven by the forces of supply and demand, and prices are influenced by various factors such as economic conditions, geopolitical events, and market sentiment. Financial markets can take various forms, including stock markets, bond markets, foreign exchange markets, which is known as Forex, commodity markets, derivative markets, and more. These markets play a vital role in the global economy by enabling efficient capital allocation and fostering economic growth. They also provide opportunities for individuals and institutions to invest, manage risk, and participate in economic activities. The purpose of financial markets has many levels to it, encompassing several crucial functions that contribute to the efficient functioning of the economy. Here are some key purposes of financial markets that I know of in no particular order. First is capital allocation. The function of capital allocation is that financial markets facilitate the flow of funds from savers to entities in need of capital, such as businesses, governments, and individuals. The significance of this process allows businesses to raise capital for expansion, research, and development, fostering economic growth overall. Second is price discovery. The function of price discovery is that financial markets determine the fair market value of financial assets through the interaction of supply and demand. The significance of accurate price discovery ensures that assets are valued appropriately, reflecting their perceived worth in the marketplace. Of course, we learn later on that the valuation of assets can be manipulated, but that will be taught in a later lecture. Third is liquidity provision. The function of liquidity provision is that financial markets provide a platform for buying and selling financial instruments, ensuring liquidity by allowing participants to easily convert assets into cash and vice versa. The significance of liquidity provision is that liquidity enhances market efficiency and flexibility, allowing investors to enter or exit positions without significant price impact. Fourth is risk management. The function of risk management is that financial markets offer a range of instruments such as derivatives that allow participants to manage and hedge against various types of financial risks. The significance of flexible risk management the market provides is that effective risk management helps mitigate uncertainties, promoting stability and confidence in financial transaction. Fifth is facilitating investment. The function of facilitating investment is that financial markets provide opportunities for individuals and institutions to invest their surplus funds in a variety of assets. The significance of this is that investments offer potential returns, enabling savers to grow their wealth over time and fund future financial goals. In our case, this mentorship will teach how to analyze price and invest based on the analysis you conduct, whether it be short-term or long-term. Sixth is intermediation. The function of intermediation is that financial intermediaries such as banks and investment firms play a role in connecting savers with borrowers, channeling funds towards productive investments. The significance of intermediation is that intermediation enhances the efficiency of capital allocation and reduces information asymmetry between borrowers and lenders. Seventh is currency exchange. The function of currency exchange is that foreign exchange markets facilitate the trading of currencies, enabling businesses and investors to engage in international trade and investment. The significance of this is that currency exchange is essential for global commerce, allowing participants to conduct transactions in different currencies. And this is also known as Forex. And I'm sure if you go to your local mall, you'll see there is a currency exchange there. It's just basically changing, let's say, USD for Canadian dollars, or Canadian dollars for euros, or euros for Great British pound. Eighth is facilitating economic growth. The function of facilitating economic growth is by providing access to capital, managing risks, promoting investment, and in turn, financial markets contribute to overall economic growth. The significance of this is that a healthy financial system supports job creation, innovation, and the development of infrastructure. And so whenever we use these different indicators, so there will be reports on the job creation, innovation, and development of our infrastructure that will indicate to us whether we're looking for very bullish price action in the market or we're looking for very bearish price action in the market. And that's how we usually see early indications of recession, is if there's a lot of job loss, etc. Ninth is income generation. The function of income generation is that financial markets offer opportunities for individuals to generate income through dividends, interest payments, and capital gains. This is significant as income generation encourages saving and investment, contributing to personal financial well-being. And then 10th is wealth redistribution. The function of wealth redistribution is that financial markets allow for the redistribution of wealth by providing opportunities for individuals to accumulate wealth through investments. This is significant as wealth redistribution can contribute to reducing income inequality over time. And so for us, we're pretty much using that quote unquote redistribution to make money off of short-term gains as intraday traders, right? So we're taking money from the banks and we're putting it in our pocket, because every time we make money, they lose money. Every time they make money, we lose money. And that goes for other traders like us. Once again, this is a brief overview of some purposes of the market. And if this interested you further, I encourage you to dive deeper in your own time. In a nutshell, financial markets play a central role in the efficient functioning of the economy by allocating capital, determining asset values, managing risks, and fostering economic growth. And because of this, their diverse functions make them a cornerstone of modern economic systems. Some of the major financial markets include the stock market, bond market, foreign exchange market, once again known as Forex market, commodity market, derivatives market, money market, real estate market, cryptocurrency market, options market, and futures market. What we will focus on in this mentorship is the futures market, but once again, a brief overview of everything else so you have a general idea. First is the stock market, aka equities market. As we get more in depth with our technical analysis, the quote-unquote equities open will be referred to, and now you know what it means. This means that the stock market exchange is open. The stock market is where shares or ownership stakes in publicly traded companies are bought and sold. Investors buy stocks with expectation of capital appreciation and dividends. Second is the bond market, or aka the debt market. The bond market is a marketplace for buying and selling debt securities, representing loans made by investors to governments, municipalities, or corporations. Investors purchase bonds earning periodic interest payments and the return of principal at maturity. The third is the foreign exchange market, or aka Forex. This is the global marketplace for trading currencies. Participants trade one currency for another, aiming to profit from exchange rate fluctuations. So just like I mentioned earlier, it's like trading your USD for Canadian when USD is high, and then trading your Canadian for USD when USD is low, vice versa for any other currency. Fourth is the commodity market. This is a platform for buying and selling physical commodities such as gold and oil, or commodity futures contracts. Participants include producers, consumers, and speculators seeking to hedge or profit from commodity price movements. Fifth is the derivatives market. This is a marketplace for financial instruments derived from an underlying asset, including options and futures contracts. Derivatives derive their value from the price movements of an underlying asset and in turn are used for hedging and speculation. 6 is the money market. The money market is a short-term debt market for highly liquid and low-risk instruments. Instruments include treasury bills, commercial paper, and certificates of deposit. These are used for short-term financing and liquidity management. 7th is something that is more common knowledge, the real estate market. This would be a platform for buying and selling real estate properties. Participants include home buyers, real estate developers, and investors. Prices are influenced by factors like location, demand, and economic conditions. 8th is the cryptocurrency market. This market is strictly digital, to my knowledge, and is an asset market for buying and selling cryptocurrencies like Bitcoin and Ethereum. Blockchain technology underlies cryptocurrencies, providing decentralized and secure transactions. And so that's all the hype that surrounds cryptocurrencies because it's decentralized. 9th is the options market. This is a platform for trading options contracts, giving the holder the right but not the obligation to buy or sell an underlying asset. Why some may choose options over the other markets is because options provide flexibility in risk management and speculation. Last but not least is the futures market, which is what I personally trade and will be teaching around in this mentorship. This is a marketplace for trading futures contracts, which are agreements to buy or sell an asset at a predetermined future date and price. Futures are mainly used for hedging and speculation. The futures market consists of standardized contracts with set expiration dates. These markets collectively form the backbone of the global financial system, offering participants a wide range of investment and risk management opportunities. Each type of market serves specific purposes and caters to different financial instruments and assets. Having a general understanding of the different types of financial markets is important so that as we progress in this mentorship, we can incorporate intermarket analysis as well. Participants in financial markets can be broadly categorized into various groups, each with distinct objectives and roles. Here are some of the key participants in the financial markets that I know of in no particular order. First are individual investors. These are individuals who invest their personal funds in financial instruments. They may seek capital appreciation, dividends, or interest income from their investments. Their goals often include saving for retirement, education, or other financial objectives. Second are institutional investors. Institutional investors are large organizations managing substantial amounts of capital on behalf of others. Institutional investors include entities such as pension funds, mutual funds, hedge funds, insurance companies, and endowments. Their primary objective is to manage and grow the assets entrusted to them. Institutional investors often have a long-term investment horizon and aim to achieve stable returns for their beneficiaries. Third are banks. Banks play a multifaceted role in financial markets. They participate in lending and borrowing, provide liquidity, and engage in trading activities. Banks aim to generate profits through interest income, fees, and trading gains. Additionally, they facilitate economic activities by offering financial services to individuals and businesses. Fourth are companies. Companies enter financial markets to raise capital for various purposes, such as expansion, research and development, and debt repayment. Publicly traded companies issue stocks and bonds, allowing them to access funds from a broad investor base. Their objective is often to optimize their capital structure and support business growth. Fifth is the government. Governments participate in financial markets to raise funds for public projects, infrastructure development, or budgetary requirements. They issue government bonds as a means of borrowing money from the public and institutional investors. Governments aim to manage their fiscal policies effectively and ensure economic stability. 6 is us, traders. As traders, we engage in financial markets with the primary goal of making short-term profits through buying and selling financial instruments. We may use various strategies, including technical analysis, fundamental analysis, and algorithmic trading. We aim to capitalize on market inefficiencies and price movements. 7th is who we are trying to profit alongside of, market makers. Market makers are financial institutions or individuals that facilitate the buying and selling of financial instruments by providing liquidity. Their objective is to profit from the bid-ask spread and ensure smooth market functioning. Market makers play a crucial role in maintaining liquidity. So, although the market makers control pretty much the markets, they are very important. So, there's pretty much a double-sided sword there where it's like they can control and manipulate the markets however they want. However, they allow us to actually participate in the market. So, without them, we would not be able to trade. Eighth are regulators. Regulatory bodies such as the Securities and Exchange Commission, also known as the SEC in the United States, have the objective of ensuring fair and transparent markets. They establish and enforce rules and regulations to protect investors, maintaining market integrity and prevent fraudulent activities. Ninth are financial advisors. Financial advisors provide advice and guidance to individuals and institutions regarding investment decisions. Their objective is to help clients achieve their financial goals while considering risk tolerance, investment horizon, and market conditions. And lastly, we have the other entity that we try to profit alongside as traders, central banks. Central banks, like the Federal Reserve in the United States, participate in financial markets to implement monetary policy. They may engage in open market operations, buying or selling financial assets to influence interest rates and money supply, aiming to achieve economic stability and full employment. Each participant in the financial markets contributes to the overall functioning and dynamics of these markets, driven by their specific objectives and roles. The interaction of these participants creates a complex and interconnected financial ecosystem. Market regulation refers to the set of rules, policies, and oversight mechanisms put in place by regulatory authorities to ensure fair, transparent, and efficient functioning of financial markets. The primary goals of market regulation are to protect investors, maintain market integrity, and foster confidence in the financial system. Here are the key aspects of market regulation in no particular order. Regulatory authorities, often government agencies, are responsible for overseeing specific financial markets. Examples include the Securities and Exchange Commission, also known as the SEC in the United States, as I mentioned earlier, the Financial Conduct Authority, also known as the FCA in the United Kingdom, and the European Securities and Markets Authority, also known as the ESMA in the European Union. For licensing and registration, financial market participants such as brokers, investment advisors, and exchanges are typically required to obtain licenses or registrations from regulatory authorities. This ensures that only qualified and reputable entities operate in the market. With this in mind, I am not licensed, so once again, everything in this mentorship is taught based on my knowledge and my accomplishments, so I am not a financial advisor. For disclosure requirements, companies issuing securities in public markets must adhere to strict disclosure requirements. This includes providing accurate and timely information about their financial health, operations, and other material events. Investors rely on this information for informed decision making. For market surveillance, regulatory authorities employ surveillance tools to monitor trading activities and detect market manipulation, insider trading, and other forms of misconduct. Advanced technologies and algorithms help identify irregularities in trading patterns. For the enforcement of rules, regulatory bodies have the authority to enforce compliance with market rules and regulations. This may involve imposing fines, sanctions, or taking legal action against individuals or entities that violate market rules. So just make sure you're not violating any market rules. For market integrity, regulations are designed to maintain the integrity of financial markets by preventing fraudulent activities, ensuring fair competition, and safeguarding against market abuse. This contributes to the overall trustworthiness of the financial system. For investor protection, regulatory frameworks aim to protect investors by establishing rules for fair treatment, transparency, and disclosure. This includes measures to prevent conflicts of interest and ensure that investors have access to essential information. For market access and fair competition, regulations often promote fair competition and equal access to financial markets. This includes measures to prevent monopolistic practices and ensure that all market participants have a level playing field. And the list goes on. Once again, if this interests you, feel free to dive deeper in your own time. But personally, I don't think that this is required knowledge for the success of an intraday trader. It's just interesting and, it's good to know. Market dynamics refer to the factors that influence the behavior of financial markets, shaping the movement of prices, trading volumes, and overall market activity. Understanding market dynamics is crucial for participants, including investors and us, traders, as it helps us make informed decisions and navigate the complexities of financial markets. Here are some key aspects of market dynamics in no particular order, once again. These factors will be covered in later lectures, but this is a general overview of what I pay most attention to. The basic principle of market dynamics is the interplay between supply and demand. When demand for a financial asset exceeds its supply, prices tend to rise, and vice versa. As I trade based on ICT's algorithmic theory, I still believe that supply and demand moves the markets, but by algorithms rather than retail intervention. As mentioned earlier, market participants can collectively come together and influence the markets based on their actions. For market sentiment, the collective mood or sentiment of market participants can significantly impact market dynamics. Positive sentiment may drive buying activity, while negative sentiment can lead to selling. I mainly see this in individual stocks and cryptocurrencies. Central bank decisions on interest rates can affect borrowing costs, investment decisions, and the attractiveness of a different asset, influencing market dynamics. This is why we don't trade the news event FOMC, because that's the interest rate statement, as it evokes large range volatility in the markets. But once again, that will be covered in a later lecture. For liquidity, the ease with which assets can be bought or sold in the market defines liquidity. Higher liquidity generally means to smoother market dynamics, while lower liquidity can result in price gaps and increased volatility. For market trends, the identification and recognition of market trends, whether upwards, which is bullish, or downwards, which is bearish, play a crucial role in market dynamics. Trend following strategies are often based on these dynamics. With institutional order flow, there are a lot of moving parts that go into it, so I'm going to be saving this for a large portion of this mentorship. As traders, we utilize technical analysis to study historical price charts and patterns to predict future market dynamics. Chart patterns and indicators are employed to identify potential trends and reversals. For news and information, real-time news such as financial reports and information dissemination impact market dynamics. Market reactions to news can be swift, causing sudden shifts in sentiment and prices. We avoid news events such as FOMC, NFP, CPI, and PPI due to these volatile market reactions. For regulatory changes in the market, regulations and policies can have a profound impact on market dynamics as well, affecting trading practices, market structure, and investor behavior. Last but definitely not least are black swan events. These would be unpredictable and rare events known as black swan events. These events can disrupt market dynamics unexpectedly, leading to extreme volatility and market reactions. As we progress into the mentorship, we can learn how to anticipate when these would occur and how we can capitalize on them intraday. Now, the definition of a black swan event means you don't know what's going to happen. It's kind of like COVID. You didn't know that was going to occur, but it just comes out of nowhere and it tanked the market. So that's what a black swan event is. However, later into this mentorship, I will be introducing you guys to a time-based concept that we can use to predict, quote unquote, when a large movement in the market is going to occur. Understanding these dynamics requires a comprehensive analysis of multiple factors and continuous monitoring of market conditions. As traders and investors, we employ a variety of strategies, both fundamental and technical, to navigate and respond to evolving market dynamics. Diversification is a fundamental principle in investment strategy that involves spreading investments across different asset classes, industries, geographic regions, and individual securities to reduce risk and enhance the potential for returns. The importance of diversification stems from several key factors. Here are some of those factors, and once again, these are listed in no particular order. Diversification helps mitigate the impact of poor performing assets on an overall portfolio. Different assets have varied performance patterns. When one asset class is underperforming, others may be performing well. This stability in performance helps smooth out the overall portfolio returns. Allocating investments across various assets such as stocks, bonds, and commodities provides exposures to different market segments. Each asset class reacts differently to economic cycles, helping balance overall portfolio performance. Diversifying within an asset class by investing in different industries and sectors reduces vulnerability to adverse events affecting specific sectors. A downturn in one industry may be offset by growth in another. Spreading investments across different regions or countries help protect against regional economic downturns or geopolitical risks. It also allows investors to benefit from global economic growth. Idiosyncratic risk, or the risk specific to an individual security, can be minimized by holding a diverse portfolio. The impact of poor performing individual stock is less significant when it performs a smaller part of a broader portfolio. Diversification aims to achieve the optimal balance between risk and return. By combining these assets with varying risk profiles, investors can potentially achieve higher returns for a given level of risk, or the same returns with reduced risk. Diversification is especially crucial for long-term investors, and over time market conditions change, and certain assets or sectors that outperform the one period may underperform in another. Diversification provides a strategy for consistent returns over the long term. So, in summary, diversification is a risk management strategy that aims to optimize portfolio returns when minimizing the impact of adverse events. It is a foundational principle for building resilient and balanced investment portfolios tailored to individual risk tolerance and financial goals. As intraday traders, this wouldn't affect us since we get in and out of markets within the same day, but as we learn technical analysis techniques in the coming lectures, they are applicable to all time frames and all asset classes, meaning that as we scale our capital up in the long run, we would begin to invest long term as well, which is where diversification comes into play. That's all for this lecture, and I hope you found it insightful as to how the financial markets operate. Once again, there is a lot more to this, so feel free to dive deeper in your own time if you'd like to. And I know that this lecture was a little lengthy. My mouth is getting dry, my throat is hurting, but it's all good. As always, see you guys in the next one, and as always, have a great day.